Hello and welcome to FinTech Diary. My name is Amol Dethe, and in today's FinTech Diary episode, I have with me Madhusudan, the CEO of KreditBee. Madhu, glad to have you.
Thank you. Thank you, Amol. Appreciate this opportunity. Would love to kind of share my views. Please go ahead.
Sure, thank you, Madhu. Ladies and gentlemen, Madhu and specifically KreditBee, the company that we are going to have today, specifically for the FinTech Diary, operates in a digital lending space or a credit space. It's a digital lending platform. So, Madhu, my first and the foremost question to you is about the credit market. How is the credit market shaping up specifically for the fintech companies like you? Because even the banks were also very cautious about the SMEs and MSMEs earlier, or the small ticket size loans. But now the fintechs are focusing only and only about this particular aspect. So my question to you is, how is the credit market shaping up specifically for the fintechs?
I think the credit market in India is a pretty large one, and on the other side, it's an untapped or underserved market. Right. So what has happened while we have about 100 plus banks, and there has been a lot of NBFCs traditionally in India operating, but there's a huge set of customers are left unbanked or underserved. Let's take some data points here, right? So if you look at the bureau penetration, right? So the bureaus carry roughly about like a 20-25% of the Indian population on their as the digital financial footprint is logged onto or tapped onto this by the bureaus. So what happens to the rest of the population, right? So there's a rest of the population is dealing with still the unorganized sector. They are borrowing from their friends, family, or the local money lenders and whatnot. So that has formed the economy for the mid India or the mid income middle class segment. So that's the larger white space, largely what we are tapping into, and also that goes with many of the fintechs who are trying to kind of do what we call it as a financial inclusion of all these borrowers or the customers. Now that's one point. The second point comes in the sense of how the entire customer trends are changing. Right. So today, more and more customers or the younger customers are getting pretty impatient with a lengthy, long process of probably visiting a brick and mortar branches led models of a banks or other traditional NBFCs. They want to have everything on top tap of a button on their mobile phones, right? So that's the convenience factor, which is also playing out heavily, which is in the advantage of the fintech. Of course, thanks to thanks to the COVID times where people went more on the digital transactions or digital way of doing the banking, which further gave an acceleration boost to many of the fintechs in the way we are offering this. So I would say that there are two things, right? So two primary aspects. One is there's a huge underserved market in India, so which has to be banked, and Indian population is very young. That a lot younger population is coming to be the banking customers. The second part is the convenience factor, what is required today for the nature of customers or the customer trends that is going on. I think most of the fintechs are trying to tread on these two particular major aspects. We cater to both of these things, and we tap onto this middle income, mid India, or the mid segment of the India is the primary focus for KreditBee as of today.
Okay, glad Madhu, meaningful thoughts here, and I think good to have the perspective on the credit market. Let me get to the specifics, and if you could share data points before we go into deep about the credit market, about KreditBee. So can you please tell me how many customers do you have? When did you started your journey into credit business? Obviously, you kind of justified why you got into the credit business by telling us the credit market scenario. But how many customers do you have? How much loan do you disburse on a daily basis? What kind of partnerships do you have with your banks and the NBFCs, the financial institutions? Could you give us some data points here?
Sure. So KreditBee itself, the journey started almost 4 years back. In 2018 is when we launched the KreditBee as a platform to serve credit needs. Primarily what we do is personal loans and credit card product to the salaried and the self-employed segment. These are the two segments what we started with. So, I mean, just to give you some idea about that, we deal with a huge population in the sense that we have almost underwritten more than 40 million customers till date, and out of which more than 6 million customers have ever taken a loan. I mean, the lifetime customers, what we have served with a loan or a credit card product is more than 6 million, 60 lakh plus people, right? So the way we run is it's a asset light platform model, wherein the platform, which is a KreditBee platform, which kind of bridges the supply and the demand. The demand is generated by these borrowers or the credit card customers who come with the new demand or a repeat demand. On the supply side, we have this lending partners. There are more than, there are more than about like 11 lending partners, likes of Chola, Mass Finance, InCred, Northern Arc, many more of them, who kind of provide the financing to these customers. Second is we also do credit score report selling. We kind of bridge the insurance products, or we market the insurance products on a platform. So there are all these insurance providers who are also on the supply side for us. Overall, we do about we disburse close to about 35 to 36 crores on a daily basis. So that's the scale what we operate with. Having said that, roughly about like 1,000 crores kind of a monthly disbursement rate. What we do, we are the largest in the segment. What we cater to today, in even comparable to many of the banks that do the personal loans. The 1,000 plus crores is done by only few limited banks, but the customers, which is the middle class, mid India segment, what we deal with, I think in that segment we are the largest in terms of how much we disburse and what kind of business we do with this customer set. Daily, we underwrite more than 40,000 loan applications from the new borrowers, and we end up giving close to 7 to 8,000 new loans on a daily basis. So that's something around the scale at which we operate. The biggest point is about the number of lending partners, right? So we also have an NBFC within our own group companies. We have more than 56 balance sheet lenders, more than 11 plus co-lending partners. I think that kind of an dynamic debt ecosystem can be only found on a platform like ours. And that is because the consistency of performance, and even not just in the happy times, but also in the COVID shocks, what this industry has seen it, those performances has kind of boosted the confidence for these co-lending partners or the lending partners who have shown more and more confidence. And that's where we are able to achieve the scale at which we are operating today.
Are you profitable?
We are profitable, right? So we are profitable from FY19. While I would reserve the numbers, but we are profitable on FY19, FY20. We incurred losses in FY21, and this financial year we are profitable again from last September.
Right.
This is at the group level.
Sure. So I want to understand something very interesting here, because most of the fintechs, you have a NBFC, that's a different part, but most of the fintech companies operating in credit space work as a lead generator for the banks, right? In terms of the personal loans or whatever loans. My question to you, Madhu, is if a customer defaults, whose liability is it? The loan default goes on obviously the fintech has not disbursed it, so automatically with the bank. And how does that work actually? How does then bank deal with a fintech company in terms of compensating that loan or something like that, and covering that losses?
So I think there are, first let me speak about the industry, and then probably I'll speak about what we do it. Right. So there are different models through which the fintechs and the banks or the NBFCs are today cooperating and coexisting together. One of the things what is very much in practice is a platform company without a regulated entity within its group, trying to partner with a third party NBFC or a third party bank, and trying to offer probably the FLDG kind of a models. I think the regulator also has raised a lot of issues in such models, because somewhere the platform is trying to do most of the banking activities, and the end bank or an NBFC has become a dormant fund provider, right? So that is one practice which is probably widely can be seen in the market. The second is the most acknowledged or the most accommodated model, which the RBI has a master guidelines, is on the co-lending model, where there is a in-house NBFC and there is a other NBFC or a bank. They co-lend together. So for example, we have an NBFC, which is a systemically important NBFC. And what we do is that we do a co-lending model, right? So we have our own NBFC and there is a partner NBFC. Both of us get together and lend to the same borrower, single borrower, right? So roughly, it depends on the ratios. Anywhere from 90 to 80% is lended by the co-lending partner. About 10 to 20% is lended by our own in-house NBFC. So we both together underwrite this particular borrower, and then we lend the money to that borrower, right? So, or even the credit card spends, what happens on a platform, which is also a major business, what we do it happens in the similar way. Now, coming to your question of what happens to the default, again, it depends again on the market practice versus what we do it. Somewhere there is a concept that the first loss coverage, what the Platform provides it in the sense that there is a first loss coverage of 5% or 7% kind of a first loss coverage, what is provided. Anything beyond that as a delinquency is absorbed by the NBFC. The first initial losses are absorbed by the platform. So for us, since we deal with the co-lending model here, so it's the losses are absorbed, both the incomes are shared and the losses are absorbed by the two NBFCs which are partnering together, right? So that's the model what we follow internally. But yeah, there are different innovations that are happening in these models on how they interact and then how they lend to the borrowers. But our practices are somewhere aligned to the most of the guidelines what is there from the RBI. So that's what we follow because we ourselves are a regulated entity.
Noted points here, Madhu. I think valid points. Uh, but I also want to now understand more in terms of the credit. Do you think the fintechs, those who are rallying towards specifically the credit side, are actually genuinely doing the best underwriting? Because what I see is everything is dependent on the data. Everything is dependent on the credit score which these fintechs have developed. And banks are also going a bit slow because they are relying completely on the fintechs since the loan price is also very low, or it's a small ticket loan. Now, traditionally, banks are very, or NBFCs are also very, what you can say, go really high on the due diligence specifically when it comes to loan. And that's why they did not touch this aspect. So again, if I come to very specifically, the point is, there is no mortgage here, there is no collateral here, and everything is based on the data and credit score. So what makes you confident about the customer that this customer is going to repay the loan? Because ultimately you're taking some call based on some data that you found really positive, right?
So let me give you a perspective, right? So for a brick and mortar led branch model, right? So which was the play of a banks or the traditional NBFCs. So it is not that they really not lend it to this customer just because they will go bust or they were bad or anything of that sort, but also because of a reason, primarily because of a reason that the credit eligibility was lower. For example, see, the mass of this middle class segment, I mean, somewhere you need to kind of tune your thoughts towards the segment what we are talking. So these are non-metro residents, which are middle class. They are earning close to about like 3 to 4 lakh annual income on a average basis, right? So, and most of them don't have a bureau footprint because they were borrowing from an unorganized sector. That doesn't mean that they were a bad customer or a delinquent customer, right? So now what is the issue there? The issue is that the eligibility of a personal loan is sub 1 lakh rupees, sub 50,000 rupees versus for a bank, the typical size what they look for doing a personal loan is 2 lakh rupees and above. Why is that, right? So because the overall physical model of underwriting, the customer has to line up. They have to go to the branches, they have to meet the branch manager, they have to supply the documents in a physical format, and then the underwriting happens, and then the sanction letter comes, and all these things, right? So this entire process does not make any economic sense, even though the borrower is good, to give him a 30,000, 40,000 rupees kind of a personal loan. Today, if you go to any bank and then just say that, even for your a profile, if you go to a bank and you ask for a 25,000 rupees personal loan, they would say that please ask me more, right? This is not going to work out. It's not that you are a bad customer, but that entire the loan amount what you are asking, that does not make sense for the processes what they have to deal with, right? So this is one of the biggest reason why, even though there is a huge good paying customers in this particular segments what we deal with, they are not being served by the banks. The second thought I would like to bring in. Today, I get about 40,000 new loan applications. Repeat loans are totally different. The new borrower loans, every day, I get about 40,000 loan applications. Think if I have to do this with a brick and mortar branches, at least assuming that I have about like 40 branches across the places, 1,000 people has to line up in front of each of the branch on a daily basis. Now the entire, forget about underwriting, even the processing itself, just to collect those files and then dump it at one room, this itself will take more than a day. Just to kind of even forget about processing. It's just about the data collection. Itself it takes the time, right? So this particular size of ticket, eligibility of the customers can only be solved using technology, right? So the technology or the app interface, the overall automation of the loan underwriting and the loan processing has to be done digitally and technology wise. And that's where the larger space what the fintechs are after. right? And that provides the huge white space why we are going after that. Now, that's the first point. So the entire notion of the fintechs or probably the KreditBee is serving what do you say, the subprime customers or anything. It is a wrong notion what everyone is carrying, because otherwise the current delinquency what we are there at about 3% and above, it cannot be achieved by dealing with the kind of a subprime segment if we were to be dealing with them, right? And more than 90% of my loan book is with the people with a bureau score of 700 and above. So why is that happening? I mean, 700 and above is a sweet customer for any bank to go after. It's about the ticket size eligibility of these guys, which does not make sense for bank to provide it, right? So that's one key concept what one has to understand. There is a fundamental issue here in terms of, forget about even after underwriting what data and all that things. There is the customer is still good. He has earning. There is a beautiful record of his earning. Only thing is he's earning about 25,000 rupees on a monthly basis. This is not making sense for the banks to provide a loan. All right. So that's one point. The second point is that now the kind of customers who are coming onto the fintechs platforms are largely younger customers, right? There is a huge credit life that they have to kind of deal with in their entire life cycle. Although they come as a personal loan, what is the typical loan cycle of the younger middle class generation, right? So they come for a personal loan to start with, for a consumption need, to buy a electronic gadget, or they want to improve the status quo of their lifestyle by buying a flat screen TV to their houses or a sofa set to their houses, or somewhere when they are married, they want to kind of equip their kitchen with a kind of a washing machine or a microwave oven or something of that sort, right? So that's where the typical spends happen. After that, they migrate to a two-wheeler loan. And finally, they have to go for the ultimate aim for these customers is to go for a housing loan, because they want to end up owning a house for themselves. Now you tell this, a young customer who is with such a larger aspiration, who has started his credit journey, formal credit journey, want to go and screw up his own bureau scores because he wants to go on default on a 25,000 ticket size loan, leaving out all his aspirations of even owning a house, which will come eventually once he starts building his credit reports and once he starts building his own income. That is when he want to reach there. That aspiration is a much larger thing for the middle class customer segment, right? So in that ways, there is a big difference between the way the things are taught and what actually happens within this particular customer base on how we look at this overall customers on when we are underwriting them, right? Of course, so what you talked about is data becomes one of the key things for us to underwrite. We need to collect data there is a alternate data models has to be developed because they have a very lesser footprints of financial transactions on the digital world. So therefore, many more alternates, subordinate data have to be kind of developed to kind of underwrite these people better, but that comes only as a later piece for this entire thesis. Okay, so in that ways, I don't think any fintech today can operate at this kind of a scale by dealing with the bad apples. That's not the case here. So we deal with the otherwise this kind of a debt ecosystem or the equity ecosystem will not support such fintech where the delinquencies go like 5-10% or 5-8%. The models does not even make sense over there.
Meaningful thoughts here, Madhu, and in fact, a very valid justification, I must say. But looking at the growth numbers, maybe 40,000 applications that you are receiving every day from the new customers, and there are a lot of fintech companies like you, which are also maybe in the similar numbers. Maybe you will be higher or maybe lower compared to many others, but yeah, they are also looking for the same. So the point here is there is a gigantic shift towards the personal loan or the credit, specifically on the digital lending side. Considering the economic situation right now, where people have lost jobs, people are still companies are still very reluctant to give the payback which the customers are looking for, and many of these customers have also borrowed a lot of money. If we play devil's advocate, by any chance, do you see some NPAs going forward in the digital lending space specifically? Because all these loans are based on data analytics, and obviously I don't have any doubt on this credit scores or something, but the economic situation itself is really wrong. I mean, really bad or sad.
I think the same question made a lot of validity during the first wave of see what happened prior to COVID, right? Prior to COVID, it was all the happy days for not just the fintechs, for everybody else, because not many of them had seen any shocks. Okay, so what happened in the last financial year was multiple events. There was a COVID wave one, then there was a moratorium, then there was a COVID wave two, that impacted. And of course, the COVID wave 3 came. Let's say that, let's forget wave 3 because it had almost zero to negligible impacts, right? So now wave 1 was the real test of the reality of the fintechs, or it was a differentiator between the grown-ups with the boys and stuff like that, right? So what you pointed out was really true, because just prior to COVID, there were 1,400 apps which were doing digital lending, right? 1,400 apps on the Google Play Store, which were doing active digital lending. And after that COVID, after the lockdowns and the moratorium that happened on the COVID wave 1, two things happened. One is the guys who had a very fickle business models, very fickle way of trying to underwrite, they all kind of shut down. So there's like today, if you look at the overall digital lending apps on the Google Play, that is in just under 100 apps. I mean, 100 versus 1,400 apps which were there just prior to COVID, right? So that was a real differentiator on who had better business models, who had underwritten better, they could survive it because they were able to collect back the money, because there was a good amount of underwriting in terms of ability to pay, and also the intention to pay was well captured during the underwriting process. While many other guys, where they were either smaller in size or their teams were lacking abilities to do this, so many of them actually kind of died out during this process, right? So that was the first shock. What was the result of that particular first COVID wave 1 shock? Following on, what did the guys who survived did? Like us or other players who are there in the market, right? So they did not sit quiet, right? So they basically kind of understood what goes wrong in such a shock event, right? So they started understanding their customer behaviors, what kind of or what cohorts of segment of customers which go bad, what profession goes bad, what pin code goes bad. So there was enough and more inputs that came to the risk teams, which they started in building in to their own underwriting systems. So COVID wave 2 by far had, if you look at COVID wave 1 and wave 2, wave 1, the virality was low, the fatality was very low. So people actually, I mean, although the shock and confusion what people had was way higher in COVID wave 1, but the overall infection rate or the fatality rate were very low, but the business impact were very high. But on the COVID wave 2, while the infection rate and the fatalities were, it was reaching over the roof, but the business impact for many of the guys who learned from the wave 1 was way lower. It was nowhere comparable to that. And the same thing happened was, and then there was a second set of learnings that came in. Wave 3 went almost as a zero impact to many of the strong players. It was really a negligible impact or no impact to companies like us. What happened with the wave 3? So how did the transition happen, right? So it's not that they don't have impacts, these shocks, but what you learn and what you inbuilt in your systems to kind of get yourself better in terms of how do you underwrite and how do you assess the customers was greatly improved. And that's how each of the COVID situations were dealt, and we all start growing. So now today, after facing all this impact, not just these things, there was a GST impact, there was multiple more things, even when the overall geopolitical situation of the war started happening recently, there were much more cautions about what could happen and what could not happen. But somewhere the guys who have gone through all these phases at scale have learned greatly that probably any other event is more of a drill, trying to repeat rather than trying to take your or kind of get a shock for yourself or kind of have a nightmares in the night. Definitely there were nightmares during the COVID wave 1, but that's not the case now.
No, sure. I think glad to know that, and let's hope that should not be the case now. Let's hope for the better world for all of us. Let me shift my focus to KreditBee now. What are your long-term plans now? You are already disbursing, receiving 40,000 applications, as you said some time back. How far will you go? And whether you also have plans to raise more capital to scale up your team. How do you want to go aggressively now into credit space than what you are all?
So first, let me give you some idea, right? So we are almost a 1,600 people company, right? So that's the current size of the company, what we are operating, and we are a profitable entity. We are Series C funded. We would go for a Series D kind of a fundraise in the upcoming days. So that's where some of the quick answers to the questions what you asked. Now, what is the long-term strategy, right? So funding is just a way of trying to kind of keep growing. I mean, if the growth is there, then funding automatically comes and falls into your cap table. So I don't think one should run for funding, but one should run for the strategy, growth, and scale, what they are kind of looking at. For us, the customer is the one who directs the product strategy for us. Right. So we have this middle class customer today who comes on the platform, who is young. More than 75% of them are from non-metro cities or non-metro residents. Quite a good of them are self-employed customers who come on our platform. So now what do we do with this particular segment, right? So today what we offer is only two primary products. One is a personal loan and second one is a credit card product, right? So there is four different verticals what we look at. One is loans as a vertical. On the loans as a vertical, we just do these two products, but the what is the typical need for them is the next is a vehicle loan. They would go for a two-wheeler vehicle, either a used or a new two-wheelers. The third thing is they look for an affordable housing loan. All right. So because they want to kind of get their house built on their in their tier 2 cities or wherever they are residing, they want to kind of build those houses. So affordable housing loan, right? So these are the different products what we would be kind of building in on the loan side. On the liability side, most of our customers cannot do a savings like like a SIP's mutual funds model that 5,000 or 10,000 can be deducted from their bank account on a monthly basis and then they can start saving. That doesn't work for them. They are earning about 25,000 rupees. They have to pay 7,000 to 8,000 rupees of home rent. They have to pay their school fees of their kids. They have to run their houses. And finally, the dispensable income what they're left with is hardly less than 5,000 rupees. Right. So that's how the budget family or the middle class family runs. Now, you cannot go and design a product like a mutual fund SIP product and then ask them to save there, but you have to give a sachet-sized savings products. It should be like in a way of saving even 10 rupees to 100 rupees on a daily basis or a weekly basis. This is how the savings happens within this community. Now, there is enough work to be done in digitizing that process to save in the DigiGold kind of a product, or we are working with mutual funds to come get that particular SIP product down to as low as 500 rupees on a monthly basis. So these are the products what we will be kind of giving out on the liability side. Right. So then on the saving side, one of the key things what they have is that most of the customers what we have today deal with the PSU banks or the public sector banks. They find it difficult to interact with the bank apps because there are like 1,000 options what they see when they log into the systems, and then they get kind of little bit taken aback on what to do here and what not to do here. A simplicity of operating on those savings account is a neo-banking opportunity that comes in for us during our strategy, during our next product roadmap, right? So all these products what I talked about is something what revolves around my customer, and the next set of things what we will build. We want to build all these things, but not in day one. Over next 2 to 3 years, I think these are the product launches what will help our customer to kind of stick to the platforms and where we can add a lot of value to these customers. Just one more point, right? So we do credit card product. Okay, so we issue the credit card. It's not a credit card. It acts as a credit card. It is a PPI wallet based card what we issue along with RBL Bank. Now, this particular card product, while the biggest option or the reward systems what we see is the launch access in an airport, right? So that's what most of these credit card products provide as a reward or a loyalty programs. Now, that doesn't make sense for my customer who is living in tier 1 tier 2 cities. They are not flying anywhere. What makes sense for them is to build offers from a value retail chain like a bank bazaar, like a big bazaar, right? The big bazaars of the world is where they go and shop. You build offers around that makes more of sense for them. So building the products based on my customer needs is something what we'll be focused on in our journey moving from here on. Yeah.
Okay, I think plan looks good. Wish you the best in the plan, Madhu. I think we are just close to our, what you can say. But still, I think maybe I will take just one more question quickly. What is the major challenge that you see the fintechs face? Is it going aggressively for raising funds, or going for growth? How do they actually manage that?
See, I think fintech space is a pretty large domain because people do different things differently, right? So now I'll give you some examples. There are multiple more cards guys today who want to issue a card to the prime metro salaried customer segment. So therefore, you see a lot of offers in the industry that there is zero fee component, there is zero interest for 3 months or 4 months, total free distribution of money business. What happens there, because those companies are looking for scale, right? So they want to kind of, because they're giving out products to this customer segment as a Me Too product. That's the third or a fourth card product, what they want to add to their wallets. These guys are, I mean, the customers are the likes of you who are there in Mumbai metro, salary, decently salaried, decent income, and decently prime guys. Now you are already carrying 3 to 4 credit cards, and then you could always tap onto any bank for a personal loan or anything like that. But now a fintech comes in to kind of offer their product. House loan comes at 6%, 6.5% kind of things are advertised, or your card products are there in the market, which give you 3 months of free credit, free cost kind of models. Now that depends on the segment what they're targeting at. All right. So what is so easy about the segment like you? Your segment, there is no risk management to be done. For me, after talking to you, I need not do any other risk management to understand whether you will pay back my money or not, right? So because that is already proven in the banking system that a salaried prime guy is supposed to pay back decently. So they go after such particular customer base where they cannot price them. That's the biggest challenge for them. But risk management becomes easier. So that is one model why you would see there's a lot of burn rates that happen, and probably they want to kind of scale. So therefore, kind of they have to burn and then they have to chase the funding. On the other side, there is a meaningful segment which is underbanked or underserved. What is the issue? I mean, that's something what we kind of cater to. What is the issue of that particular segment is risk management is a key there. That's what we excel in. Once you do a proper risk management to the customers, you can actually price them accordingly. Right. So, and once you price it, you are bound to be profitable, and you not really run for your fundraise. See, lending is not I'll always tell this, lending is not some innovative business. Lending is existing for thousands of years in some format or the other format, and people have made money out of this. Now, if somebody is not making after a decent size or a decent years of existence, so therefore the model is taken totally wrong. So it depends on fintechs to fintech, what customer segments they are kind of chasing, and where they want to get the growth and at what pace they want to get the growth drives your need for funding at an aggressive path. So, and then one should not, just because the market is hot, one should not just go and dilute themselves unnecessarily when there is no need of money also. All right. So there are multiple things come in. I think we cannot bucket everybody together and say that everyone is chasing for funding or they are kind of raising fund, because ultimately the public markets or the IPOs are a real testimony of what will happen by just going on a crazy valuation or a crazy raise of funds. As long as there is a value to the business, what you do it, this is much more appreciated, and that's different for different companies in the space. Yeah.
Oh, sure. I think I'm done, but let me just take one last and a quick question, which you also partly touched about the IPOs. There is a rally about going and hitting the stock market or raising through IPO from the fintech side and the startup side. Do you at KreditBee has any plans for doing that?
No, definitely, right. So we would want to hit the IPO market for sure, but not in cards for this year or next. Probably in the FY24 is something what we might look for an IPO listing, but there is no question about that, whether we should look for it, or any company for that matter, that whether they want to list or not. You wouldn't list, listing is the ultimate thing of how do you kind of further fundraise, how do you get more regulated, because your numbers are public, and you get the retail market, your compliances grow stronger, and you are more appreciated by the lending fraternity, like the banks or anybody, to kind of come and lend, or even the external borrowings, what you might want to do from in the dollar terms from an outside the cross-border borrowings, what you would do. So everything, that's the testimony of it, because there's a very regular filings and regular update about your financials in the market. So that is something what is a holy grail, right? So everyone would hit that. It's only a matter of time that what is the comforts what one has to take to kind of go and hit that particular market. For us, it's the third year plan from now on is what we look at it. But yeah, I think the question about whether to list or not, I think that should not be much of a concern for any company for that matter, or any fintech company. I think that's what is our ultimate aim of going and listing ourselves in the public markets.
Yeah, sure, Madhu. I think remarkable points here. Thank you so much for your time and sharing your perspective, not only from the KreditBee side but from the fintech industry side. Thank you for being part of FinTech Diary.
Thanks, Amol. Enjoyed this talk. Look forward for further talks like this. You take care. Bye-bye, guys.
Sure. And that's the wrap, ladies and gentlemen. That was Madhusudan Ekambaram, the CEO of KreditBee, who shared a lot of information about the fintech industry in India. Thank you so much for watching.